What's going on, guys? It's Garret Fields with Nelson Financial Planning here. So today I wanted to talk about why the markets are negatively reacting to the Fed's increase in interest rates. But before we get into that, we have to understand how these interest rates affect the economy. See, when the Feds increase interest rates, those rates trickle down to everyone. It's one of the main reasons why mortgages have gone from 3% to over 7% in less than a year. But it's not just mortgages. It's all loans, including business loans. And this increase in expense in order to borrow money can directly eat into a company's underlying profit. And a less profitable company should, in theory, have a lower stock price. So why is the Fed doing this? Well, when Fed makes money more expensive to borrow, typically people borrow less. This cuts down on the money supply, and in theory, this should put a damper on inflation. But if you have any questions on the Fed, inflation, or how to navigate these extremely volatile markets, give me a call at 407-629-6477. I'd be happy to chat with you, and consultations are always free. And as always, stay safe, stay healthy, and invest consistently.